Good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast, where members of the media, academia, and financial services discuss all the issues related to retirement markets, technology, personal finance, and so much more. I'm Jeff Snyder, your host, and we're going to have a great show today. So sit back, relax, and enjoy this episode of the BRN Sunday podcast. Well, let's kick things off with a look at healthcare, and obviously healthcare big in the news right now. And joining me on the line, she's the senior correspondent for Business Insider in the healthcare space, Ms. Lydia Ramsey. Hi, Lydia. How are you?
Hey, I'm hanging in there.
Yeah, and I should also mention that you are also the editor of Dispense, which is one of the more popular healthcare story aggregators out there. So, Lydia, obviously, coronavirus, vaccines, healthcare is top of mind. What can you tell us? What are you covering in the pages, the virtual pages of Dispensed and Business Insider?
Yeah, I'd say a lot of my coverage for the past couple of weeks, as we've seen the outbreak really ramp up here in the U.S., has been focused on the U.S. health system's response. You know, how are hospitals preparing? What are doctors doing on the front lines? But it's such an unprecedented time. A lot of folks are trying to figure that out. It seems like a lot of folks are really worried about a number of things posing challenges. Obviously, testing has been a big issue. Getting access to testing has really been plaguing the U.S. response. That's increasingly becoming more and more available, but you know, we're talking still tens of tests versus hundreds of tests, and then hundreds of tests versus thousands of tests. So we'll learn a lot more about how bad things are once we get more testing online. So that's step one. It's been interesting to hear a lot more too about how hospitals are bracing for things like a surge in intensive care patients. We've seen over in Italy a high percentage of cases do require really intensive care, requiring hospital stays, requiring stays in hospital beds. And if that starts to happen in the U.S., it's going to put real pressure on the system. Our system is not built to run at a capacity to fit a pandemic because we haven't really needed to for a pretty long time. Yeah,
that's certainly, I think that's one of the more underestimated. I mean, certainly everyone's focusing on being infected. You see all these cancellations happening. There's social distancing, which basically means everyone just go home and don't touch or talk to each other. Or maybe you can talk to each other. But I think of real concern to many people is the healthcare system, and can it handle, can hospitals handle this? And from what I've read, and interested in your feedback, I mean, already healthcare workers here in this country and across the world are exhausted, right? I mean, they are working around the clock. Either they're attending the patients, they're trying to come up with solutions to the virus. I mean, they're coming at all different angles, and I think that's really disconcerting.
Yeah, absolutely. And it's really tough. Some hospitals are calling folks back from vacations. Some are thinking about, asking folks to come out of retirement and really step up. It's going to be an all hands on deck situation. I'm spending a lot of my time talking to people, even on the front lines. A lot of these communications have been to talk to your primary care doctor. A lot of primary care doctors don't have the tests available to them. And so people are getting stuck in really tricky positions. Like, do I just send them to the ER? Do I try to treat them myself? How do I do that appropriately? How do I keep myself safe? How do I keep my other patients safe? So it's a lot to think about as a healthcare provider.
And also, we know that the president, I think in his remarks, and I think subsequent to his remarks a couple nights ago, that insurance companies will be covering some of the testing, right, or all the testing. I think that regardless of what plan you have, there will be coverage on that once the tests are actually available. And that's, I guess, a positive step. But again, I think people really don't recognize, I mean, I know I didn't, just speaking for myself, I didn't recognize all the domino effects and things, how impactful this is across the healthcare ecosystem.
It really is. And I think there's an important caveat to your point about what the president is saying is happening. A lot of health insurers that I've been speaking to piecemeal have said, yes, we're going to cover the costs associated with testing. But it's important to keep in mind that we're just talking about testing there, right? We're not talking about a hospital stay if you need it for the treatment of the virus. We're not talking about all health plans either. A lot of folks gave their commitments and have said so publicly, but a lot of self-insured employers, so that's employers like, big banks like JP Morgan or, a company like Amazon, they fund their own healthcare for their workers. Obviously, they're probably going to do this, but they are a carve-out here. They may have a $20 copay, something like that. They may have a different system. They aren't necessarily under the same kind of commitment that other plans are.
Let me ask you a question. You do a lot before this outbreak and kind of maybe a shift in your coverage. You had covered a lot of startups. We've had conversations over the last year about these biotech startups and people doing different types of blood test work, or Walmart's or the CVS's opening up different, Amazon and doing whatnot. What can you tell us in terms of, are you seeing more interest from these startups in terms of dealing with this specific issue? Are they jumping into the fray? How can we help out? Whatnot?
Yeah, I think a lot of folks are trying to figure out what role they can play in the best way possible. When it's an insurer, it's covering the cost of testing. If it's a company like CVS, they're offering free prescription delivery right now so that people don't have to kind of come into contact with other folks if they're not feeling well, or even if they just want to avoid other folks who might be infected. We're seeing a lot of people take up really creative ideas. You see some of the direct-to-consumer healthcare companies. Roe last week announced that they would help kind of screen patients for free and see if they needed to go to the doctor, which hopefully, gets out a lot of worried wells. I know there's a bunch of people here in New York that are thinking, oh man, I have a cough, I have some sniffles, do I have coronavirus? And it's a really real fear because we don't really have a clear handle on how it's spreading and who might be coming into contact with whom. But hopefully systems like that can help out. I've been talking to a lab testing company that distributes kits called Everlywell. They do it virtually. So basically you order the kit, have an online consultation, and then you get a kit sent to your home. And that could ultimately, if that comes online, like they're hoping to by mid-April, that could help increase testing, number one. And then number two, really keep a lot of folks out of the hospital that don't need to be there.
Yeah, so reducing some of that strain that you were talking about earlier to the health system. Lydia, I think this is the last question, although I can't promise, but maybe we'll have a follow-up somewhere down the line in a couple of weeks. In terms of scams, I've been reading online, there are coronavirus scammers now, people who are selling faux products, things like that. I mean, that's got to be a concern for people who are either part of the FDA, part of the regulatory agencies, right, that you can go on Amazon. I know Amazon and some of the other retailers are trying to cut back on that stuff, but it just seems so ridiculous that people would be opportunists like that and try to sell fake masks and fake vaccines.
Yeah, I think we see this with any kind of public hysteria. It happens. It's going to happen. I think the only thing you can really do is try to find the most accurate information, the best information. There's a lot of great resources out there. CDC has been keeping their website pretty up to date, and it's a really great resource. I've used it a lot as, a general consumer. I've used it a lot in my reporting. It's always great to look there, keep your eye out for news articles, things like that. And it's really going to be important as this develops. So many articles are being written, so much is being discussed. It's going to be really important that folks, can sort through the noise and see, okay, maybe this approach isn't actually real. Maybe I don't need to buy this weird looking test on Amazon. Trying to find the most accurate information is going to be really key here.
Yeah.
And I only hope I can help with that.
Yeah, absolutely. Well, you perfect segue into certainly look at the CDC website, but if you want someone and a team that aggregates the news as it relates to healthcare, check out the Dispense newsletter. And Lydia, that's free, and people can subscribe through the site and also through the Business Insider site and also on LinkedIn, right?
Yeah, I just started publishing it to LinkedIn, so it's up there now. It's got a kind of roundup of all the news we've been covering, mostly focused on the healthcare team here at BI, but that's become bigger as more folks are jumping on the topic. I don't think this is missed any part of the newsroom. So lots to talk about. So hopefully I can sort through some of the noise and keep people informed of what's going on.
Absolutely. Well, you did a great job today. Lydia Ramsey, stay safe. Have a great weekend. And we'll talk to you very soon.
Thanks so much. Bye.
Welcome back. And joining me now is Senior Technology and Consumer Products Reporter with The Motley Fool, Mr. Daniel Klein. Hey, Dan, how are you?
I'm good. I feel like I'm a bit self-quarantined, even though there is no sign of coronavirus here in West Palm Beach.
Yeah, well, let's keep our fingers crossed. And like you, I work from home. We often talk about it and joke about it on the network, but it does feel very isolating. And I have been practicing, what's it called, social distancing for a long time.
Yeah, see, I'm someone who I work from home, but I travel a lot.
Yeah.
I was supposed to be in our office next week. We've closed our office till April 1st as a precaution. I had a conference I was going to canceled. So these are all smart moves. But for those of us who work from home and sort of crave human interaction, this has not been a great thing.
Yeah, I agree on so many levels. So Dan, let's just jump off. And I know one of the stories you wanted to talk about, and I can't believe this that we're even talking about this, but scammers and coronavirus scammers. What can you tell us about this? You know, there's always someone trying to make a quick buck and to rip people off, whether it's the tax return stuff that we've talked about or now this.
Yeah, we've talked about that. Amazon has removed hundreds of thousands of listings that were considered price gouging. You know, somebody buys a bottle of Purell and then tries to resell it for $100. But when it comes to scammers, you need to be careful where your information is coming from. So if you get an unsolicited email that tells you buy this and it will protect you from coronavirus, that's probably not true. Even if the email looks like it comes from a credible source, really look at what is the address that sent it to you, because your health insurance uses an email address that has the name of that healthinsurance.com. It doesn't come from some nonsense email address. So be very, very skeptical, because there's a lot of people out there willing to prey on fear who are trying to make a quick buck.
Yeah, I think you make a lot of sense, and I think you bring up the website. The CDC is the place to go. The Center for Disease Control, right? That is the place to go for all things related to this virus. So don't be fooled by bad actors. And Dan, it just seems like they crawl out of the woodwork trying to take advantage of people, especially the elderly, which gets on my nerves.
Yeah, and look, you want to look for credible news sources. Obviously, the CDC is a good place to go, but and I say this with trying not to be political, don't necessarily trust what politicians running for office are telling you.
Absolutely.
And realize that there are factors in the government that are trying to do things like minimize the impact on the stock market. So some of the potential for this has been underplayed, and in some cases it's been overplayed.
Yeah.
So really what you want to do is look for scientists, doctors, credible sources, people speaking on CNN, NBC, ABC, CBS, very credible news organizations, no matter what you've been told by people who have different political interests. One of the things we've been trying to do at Motley Fool is be very rational about this whole crisis. So yeah, is the stock market plummeting? It is. But look at the stocks in your portfolio, and if you believe in those companies, they will recover. Unless you believe that this will be so bad that it will literally change how people react forever. And I don't believe that to be the case. If you went to Starbucks a month ago, you might not go next month, but you'll go 3 months from now when it's all cleared up, or I don't know what the dates are, but eventually normal will return.
Yeah, well, I think that's a good point, and that don't let those emotions drive you. Dan, let's shift gears, and I want to kind of get away from the coronavirus stories because I think everyone's doing them. A lot of it's overplayed, to your point. And let's talk about Netflix. And I think they came up with a different service for a different location of the world. Is that correct?
Yeah, this is a really interesting one. Netflix in Singapore is offering a mobile-only service that costs roughly $4. And basically the idea is it's a country that largely has lower-end phones, not as much high-speed internet connectivity. So this is SD, not HD streaming, and it's an inexpensive way to get access to Netflix on a phone, which is obviously not as good as experience as a television or even a laptop. So the interesting piece of this could be a model for something that happens in the US, especially with 5G networks very slowly rolling out. You might see a different Netflix pricing tier that only gives you access on your phone. You might see a very restrictive plan that doesn't let a family share it. It might be a single login, but you're definitely seeing different types of things.
Yeah, look, Dan, I got to tell you, I probably don't know the definition of SD or difference between SD and HD, and I would go for something like that if it would reduce cost, and it might say to me, hey, I might want to try different services if they were going to come to that, because I don't think for my eye it doesn't really matter.
Yeah, I mean, look, if you're watching on a big screen television, the difference between HD and SD is noticeable.
Okay.
And in my case, T-Mobile pays for most of my Netflix subscription, but I know that I consume Netflix almost entirely on my phone. My
Ah.
wife would disagree. She watches Netflix when I'm traveling on the television, so we wouldn't be able to downgrade. But a lot of subscriptions we have, Disney Plus. I loved The Mandalorian. It's an incredible cinematic show, and I think I watched 6 of the 8 episodes on my phone. So if you look across all these services, I think you might see an option to get more subscribers by offering a cheaper phone only subscription, especially when you get to Peacock and some of the new services that are launching that maybe have less appeal. I might say, oh, okay, like I want to watch old Saturday Night Lives when I'm traveling. I'll pay $2.99 a month for that, but I won't pay $6.99 or $7.99 or whatever they're charging for the full thing. We're getting to subscription overload, so I think companies are going to have to be more flexible and find ways to bring more people in.
Hey, Dan, a question before we close out the segment, but a question about I just subscribed to YouTube TV. So, I was a Hulu user, decided to go to YouTube TV to try it out. And what's interesting is they have like a family plan. You can actually share it with 5 different people in your family, or, you have to have like a Google or Gmail account and whatnot. Thoughts about that? I mean, is that a good way to, spread the cost around? So it's $49.99 plus if you buy, we don't buy movie packages, but you could literally spread it around and pay $9.99, I guess, if you do the math.
Yeah, absolutely. So we tried Hulu Live, and I had issues with the DVR. It didn't really work for us. It forced you to watch commercials on some shows, even with the upgraded DVR. And for me, someone who's watching a lot of television after my wife has gone to sleep, maybe I have a 45-minute window before I go to bed, the added commercials were not beneficial. But yeah, I mean, there's a lot of things like in theory, you can get Apple Music and share it with a family member as long as you're willing to give them access to your account, which means they could charge things on your account. And for a while, I shared my Apple Music with my mother, and I forget why, but we don't anymore. So yeah, it's, well, I think it was an aspect of her wanting to buy things and not wanting to have to go through the headache of reimbursing me.
I get it.
Uh,
It just sounded
but
funny how you delivered it.
yeah, in the case of when you can openly share, I think that makes sense. I mean, look, if people were really smart about it, the best way to have mobile phone service would be to get a family plan and share the expense across a broader family. But from a practical point of view, do you really want to Venmo or PayPal, your cousin $30, or oh, the phone bill went up $3, so now it's $32? Like there's a practicality where they're not splitting up the billing. I mean, we've all experienced this. You go to a restaurant, and if you're eating with millennials, and I have many colleagues in their 20s and early 30s, and every single person pulls out a credit card. Nobody has any cash. And it becomes this ridiculous exercise in bill payment.
Yeah.
So right now, very few services are facilitating that. But going forward, I think we're going to have the ability to share things because these companies are going to be desperate for subscribers, and they're going to be more willing to let you sort of spread the cost out. Now, of course, you're also going to get pushback from television networks. Some of these subscription services are limited in what they have and have holes because maybe Disney is saying, hey, you know what? This is not true in the case of YouTube, but we don't want ESPN part of a service where 5 people can share the cost of ESPN.
Yeah, and I wasn't even. I just like the fact that we can. I wasn't planning to split the cost, but I like the fact that my family we can all kind of share the same thing, and we don't all have to pay $9.99. We can be in different households and do that. So that was my thinking. But appreciate the insight, Dan. Always a pleasure chatting with you. And I'm sorry that you are home. And I wouldn't say bored, because you're never bored, because you're always writing your great articles. But certainly appreciate talking with you and look forward to having you on the network on Tuesday.
Hey, we're all healthy, so that's all I can hope for.
Knock on wood, my friend. Talk to you soon.
Talk to you soon.
Welcome back, and now we are going to shift gears, talk markets, and I've been waiting all week to chat with Oliver Rennick. He is the lead anchor for the TD Ameritrade Network, and you can catch him every morning and every afternoon as he opens up and wraps up all the news related to the markets. Kevin, I was going to call you Kevin. Oliver, great to have you back on the program. You see, we were talking
Thanks,
Kevin
Jeff.
before, and you just totally, Freudian. What can I say? Oliver, okay, take us through what you learned this week. I don't even know where to begin.
Man, yeah, it's pretty intense. It's been a very long week. It has been definitely the most intense and arduous 5 days of my career, no doubt. Just watching the speed of the market, watching the intensity of the fear building on a just social level, and seeing those two connect in a way that does make sense, I think, but also presents us with some really interesting questions, because we now are in the fastest occurring bear market in history, so the fastest 20% drop from a high. And I think that is really the first big takeaway, which is we're in bear market territory, but to call what we've experienced a trend is really, I think, a mistake. I think you have to label this as a crash. The market crashed, and that is in line with all the historical comparisons. We had the worst day since 1987, and there is a weekly number we'll get soon on what the weekly decline will be, but overall, this is obviously a move for the record books. Volatility is measured through the VIX, got to levels we haven't seen since the financial crisis, and moved with speed again that was fairly unprecedented. Was unprecedented. I should just make that clear. There's no fairly. It was unprecedented.
Yeah.
It's a black swan event. The catalyst is, of course, the coronavirus. And the shutdown of global economies and activity is like nothing ever seen before. Yet this market does move very fast. It's been moving very fast for a long time. 2018, when we had that sell-off in December, it was the worst December, a single month period since the Great Depression. When VIX exploded in early 2018, there were metrics by which that move was unprecedented. So it feels like there are some of these underlying market issues that many people have pointed to for a long time that are now kind of coming out in terms of kind of skeletons of the closet. Nobody predicted this thing. There have been bears on the market forever that have been talking about bubbles and Fed stuff and this stuff, and there's no there's no real connection to that from a causal standpoint. But basically now the question is, even if coronavirus, let's say in some magical world, we miraculously stop coronavirus instead. Okay, let's just say no spread throughout the United States and everywhere else the numbers start going down. What does the market do? And that's a really hard question to answer, I believe, right now. I believe if that were the case, you would obviously get a very powerful sentiment relief that would help to restart the economy in a very good way. But when you have moves like we had with crude oil on the OPEC plus fallout, just getting absolutely obliterated, when you have moves like what we saw in Boeing, a very widely held stock, a very long-term stock that everybody thought was going to be safe from anything, just get annihilated with the worst drop in 50 years. These type of things, these type of moves are so intense and fast and unpredictable that we will definitely, I suspect, find out there are indeed some skeletons in the closet. That's probably yet to come. So you kind of open up a whole other bag of worms, even outside of the main cause of the event, which was the coronavirus. And that's kind of what you have to deal with eventually, while you're also still trying to assess the economic fallout with the coronavirus, which we just have no clue. Markets are definitely now across the board basically pricing in economic devastation. And there's probably a debate to be had about the likelihood of that coming true, given that at least one part of the world, China, is starting to come back online, which is very, very important.
Yep.
So yeah, there's a lot of tough questions.
Yeah, let me go back. I'm a simple guy, as you know me for a while, so I'm a pretty simple guy, and trying to make it, rhyme or reason of what's happening. How much of this, we talk about investor sentiment and the sentiment of the market, but how much of this is driven just by the reporting on this stuff? And present company excluded, because I think the network, the TD Ameritrade network, I mean, you really look at things from an analytical, statistical perspective. But how much of this is,
Thanks.
the market, your audience respond, people looking at your programming is just growing leaps and bounds, and I think that is a testament to the great work you guys and gals are doing there. But
Thanks.
how much of this is driven by just this irrational reporting, this 24-hour news cycle that we're in, and it just drives? Does that drive hysteria? I want you to put on your media hat now. So put on your media analysis hat, because you are part of the media. But I want you to give us your thoughts about what I just stated.
It's a very tough question, because when there's no doubt that no matter what event occurs today, there is a certain degree of sensationalism attached to it. But I want to choose my words carefully, because obviously you don't want to downplay the real impact of this thing, because it's lethal. But it's also, it seems very regional dependent as well, right? You have tons of testing in South Korea that gives you a mortality rate that is, twice as bad as the flu. Then you have something like in Italy, where it's seemingly unstoppable and killing people at an extraordinarily high rate that is like 100 times what's happening in Korea, if not more, like 400 times what's happening in Korea. So the tough question is kind of figuring out how the description and coverage of an event correlates with the market move. And what I mean by that is, when we don't have any blueprint for assessing the economic fallout of such an event, we can only guess right now. We can guess that it's going to be bad, but how bad do we know? If you think about these things as change over time, as sort of a derivative, if you will, a vector basically of how quickly the market is moving and how quickly the disease is moving, I do think there is a point to be made, which comes back to your question, which is the fear and the coverage of the disease moving at a faster pace than the actual disease? And how does that pace compare to the pace at which the market is assessing these risks? It's very possible that the market is now moving at a faster pace because it didn't move at a fast enough pace to begin with. Okay, so for example, China stocks peaked in mid-January. January 17th, China stocks peaked because it was obviously a problem for China before it was a problem for us. So the market here continued to rally up until February 19th. So there was a month there where one now can argue in retrospect, of course hindsight is 2020, that our stock market was not moving at a correct speed based on the speed of the virus or the potential of the virus. But then now one could possibly make the case, which some investors now are, that the market is actually moving at a faster pace than the virus is. So the market's like caught up and then some. Now, this is a really dangerous game to play, because we just don't have precedent and we don't have a lot of clarity on how the disease works. It's still very, very early in the goings in terms of understanding it. But given that for the market we can at least quantify in history what's happening, in the market we have an entire history book that we can compare to. And right now the market's only comparisons in history to what we're experiencing over this last week are the biggest, most consequential turning points in the history of economics, basically, which is the Great Financial Crisis, the Great Depression, 1987, and now we have to ask ourselves, how certain are we that our underlying fundamental impact from this virus will match the fundamental effects and fallout that happened in those scenarios, namely 2008 and the Great Depression? And I think there's a very robust debate to be had about that, because there's a huge blackout of activity that is very alarming from an economic standpoint. We have no idea how long it's going to last. It could be even worse than 2008 or 29. It could be way less. but the range of possibilities is very wide, and the consensus right now is that the range of possibilities is very wide, but only on the negative side, only on the very, very destructive side. And we can assume that based on the market's historical comparisons, if that makes sense. So I do think there is something to be said about your point here, which is that maybe it's possible. It's definitely possible. There's a non-zero possibility, I would assign, definitely, that the market, particularly in some of well, in everything now, it's stocks and bonds, could be potentially erring somewhat on the side of panic.
Yeah. And I didn't mean to put you in a position of being a media critic, but I think it's interesting to hear your perspective.
Yeah, no. Well, that's more of like a market take. I kind of dodged that part.
Yeah, that's fine. But I think, and I'm not inferring that it's done on purpose. What I'm saying is that the quest for eyeballs can often drive the way stories are reported. But that's not the case.
Some stories are a little bit ridiculous, right?
Yeah. Right, and that doesn't happen. That doesn't happen on the TDA network because you guys actually use quantitative and statistical information to rationalize what you're reporting and how you're reporting it. So let's move off of that. Last question. We had volatility last year. We had volatility. You mentioned December. We had the worst December. Is this the new normal? I mean, I'm going to ask you this question again because I asked you the question back then on both occasions. Yeah. Is this the new normal? We're going to be subject to these wide swings in the market just because of the world we live in and the events that happen in our world?
For the time being, right now, the answer is yes. You just don't get, you don't get moves like this that aren't followed up with something. So the answer is yes. You don't get moves like this that then just go back to normal. Yeah. Now, I also think there's a strong case to be made that given the speed on the way down, we could have an equivalent speed on the way up when we do recover. But that still is volatility. It's just upside volatility. So no matter which way we go, it's going to be with some serious energy.
Yeah, absolutely. Well, Oliver Rennick, always a pleasure chatting with you, and thanks for sharing the insight that you have gleaned over the last couple of weeks through your programs, and we wish you a safe and wonderful weekend.
Thank you, Jeff.
Thanks. Bye-bye. Welcome back. And I'm going to shift gears, talk real estate, and who better to do that but the real estate reporter for Dow Jones Market Watch, Mr. Jacob Passy. Hey, Jacob, how are you?
I'm hanging in there. How are you?
I'm doing well. It's not, working from home, not easy in general, because especially if you're a social person like I am, and I know you're very social as well, so it's not easy to do, but I'm really happy to be able to talk to you every week on the podcast, so this makes me happy. So what's top of mind for you as you're looking at the real estate market? I would imagine that we had low interest rates. We were talking about it last week, but I think, maybe this whole coronavirus thing has really thrown real estate into flux too, I bet.
Yeah. So, one big thing so keeping on the subject of rates. So, interestingly, this week mortgage rates actually went back up. So they, even though the 10-year Treasury, which, mortgage rates are long-term rates, so they track like longer-term bond yields. So the 10-year Treasury hit another all-time low this week. Obviously there was the biggest one-day downturn in the Dow Jones Industrial Average since 1987. Not a great week for the markets, but mortgage rates actually still, they actually went up, and so we've got an interesting thing going on here in the mortgage market, which has effects for pretty much everyone, whether you're a homeowner who's looking to refinance or a person who's looking to buy a new home. So, last week we talked about how mortgage rates hit an all-time low, and that spurred a massive wave of refinance applications. Lenders were getting more applications than they've got, I think, since 2009 for like a weekly volume. It was insane. And experts I talked to were saying that loan officers at mortgage lenders were processing 4 or 5 times as many applications as they normally do. So this is a massive work situation for lenders, and it's created a huge backlog. And so that has a lot of effects. So first off, it's taking longer for lenders to process these applications. Part of that is because, of the massive demand, the massive number of applications they got. Another factor here is that, in the last half of last year, lenders were actually starting to draw down the size of their companies. They were laying off workers or not replacing workers when they left, in part because mortgage lenders have to be responsive to where they see the market going. And so there was a perception among lenders that they had seen the end of low rates, and that rates were probably going to start slowly climbing back up through 2020, 2021, 2022. And you never want to be, as a company, a lender never wants to be in a situation where they have more employees than they have business. They don't want to have, employees sitting there doing nothing. So lenders will try to, adjust the size of their employment base based on that. But that turned out to be, hindsight's 2020, turned out to be a bad move for many lenders. So a lot of lenders have been left kind of flat-footed. They don't have enough workers to go around to handle the demand. And then on top of that, there's an extent to which lenders can outsource some of this, application processing to. There are a number of companies that handle, mortgage outsourcing services and do these sorts of things on behalf of lenders who have, smaller numbers of employees. But even those companies are, kind of tapped out at this point when it comes to the amount of work they can handle. So, in response to that, lenders have actually increased rates, and they did that largely because, first off, they want to slow down demand. So a lot of lenders pull their if you've gone on a site like LendingTree or Bankrate, you may have seen less mortgage quotes than you normally do. That's not an accident. A lot of lenders actually pulled their listings from those sites because they just don't need the applications right now. And if anything, they want the reverse. They want, they don't want anyone to apply right now. So, so basically, another thing that a lot of lenders did is raise rates. They wanted to make it less attractive to refinance or apply for a loan right now, at least temporarily while they work through this backlog. And so, the good news is if you didn't get to put in an application last week for, a new mortgage loan, whether it's for a refinance or a home purchase, there's still going to be time, once lenders do work through this massive, stack of applications they've all got on their desks. They will probably bring, the situation causing the low rate environment that we're in right now is the coronavirus outbreak. That's not looking like it's going to end anytime soon, unfortunately. So, and then even when it does, with international travel being brought to a screeching halt basically right now, and tons of people working remotely, that's bad for retail. So, a lot of economists have previewed the potential for a recession caused by the outbreak. Might be a short-lived one, but a recession nonetheless. So that will have, an effect on rates moving forward. So rates, any economist you talk to right now would say that mortgage rates, this, increase might be more of a short-term blip. The long-term, or at least medium-term here, is that for the next few months, rates will probably remain quite low from a historical perspective. So if you haven't missed out on any chance to refinance, but if you have put in an application, I've also talked to lenders about that, what you should expect there.
Yeah, I mean, it seems like that seems a natural course of action if you're getting all these applications and you don't have the staffing and you don't want to hire more people, or you don't even want to hire them on a part-time basis to deal with it. It seems like the only thing you can do is raise rates, and that will naturally choke it off. Jacob, I want to ask you a question. You may not know the answer, but I'm assuming you do because you know everything, and you have your boots nose to the ground more than I do in this arena. But what about the impact to just home sales with the coronavirus? So, like, thinking about going to open houses, right? I wouldn't be caught dead opening my home to anybody for an open house, and I wouldn't even if I wanted to sell my property, and I wouldn't be caught dead going to an open house. What's the impact of this to
Yeah.
home sales?
The impact remains to be seen. We're still, it's still just early March, so for much of the country, the peak spring home buying season still a couple months away. April, May, early June, those are
Sure.
kind of the peak times. So, we're still, or at least maybe not a couple months, a few weeks away. So there's still time. Hopefully, the situation somewhat resolves by then. But you're exactly right. I mean, the economists, the jury is still out on, I think as things have progressed, the forecasts have gotten more and more pessimistic. I think, a couple weeks ago, with interest rates as low as they are, with the, economy, before all this started, was in a really strong position. The labor market especially was very strong. We finally have seen wage growth, picking up again for many workers. All those are, a perfect recipe for, good sales. Although the caveat to that, as you and I have discussed many times, is that home prices were so high for much of the country that obviously makes it hard to afford to buy. So, if you are someone who locked in a low rate last week who's going to purchase a home, you're in a pretty good position. And so, the Mortgage Bankers Association did see an uptick in applications for purchase loans, in addition to refinance loans, but not quite as big of an uptick, which is usually the case. I mean, low rates don't usually stimulate quite as much buying frenzy as they do a refinance frenzy. So there's a boom in refinances, not necessarily a boom in sales. That would lift sales normally, but the big question mark right now is consumer confidence. How freaked out are people right now? And I think people, if you look at the supermarket shelves, I think people are freaked out.
Yeah.
And so, if you, and this is where, lawmakers right now are debating issues related to paid leave and things like that. You have seen a lot of companies saying, all of our workers will receive pay, even if we have to, move to a remote work setting, which for some people means they're just not going to be working for a period of time. So, all of that is going on. I haven't spoken explicitly about this to economists in the past couple days, because in addition to the real estate beat, I've also got the travel beat, which has been exciting to cover, to say the least, these past few days. But I think look to the consumer confidence measures for February, March. Those come out in the next couple months, weeks, and those will be the biggest indication of what we can see in home sales. I think, I would wager that, that home sales are probably going to be hit a bit by this, because I think, people are just, when buying a home is the biggest purchase someone will make in their lives, generally speaking. And are you really comfortable making that big of a purchase right now, given what's going on in the world?
Yeah.
Now, that being said, I live in New York City, where, this is kind of, New York has many cases, things like that. In a state like Maine, where they just had their first case, maybe the market won't be as hard hit. All real estate is local. So if there aren't a large number of cases in your area, and you're looking to buy or sell, I'm not telling you to hold off. If you're still gainfully employed, not worried about those things, and you can look at a home and buy a home, more power to you. That being said, something to keep in mind if you're buying a home is if quarantines start occurring at a larger level, if states, cities, the whole country, quarantines itself, or, goes into lockdown like we've seen in Italy, and now Spain is doing something similar, and other countries have announced similar moves, or that they might make similar moves. If that happens, that can complicate a lot of the process. There are a lot of things that you have to sign, obviously, when you buy a home. And so, if we're in a situation where we're under lockdown, In some states, you can sign things remotely. There is about, I think it's like 23 states now nationwide that have passed remote online notarization laws that allow you to sign mortgage documents and other documents through a remote online notary, like through Skype and computer system that replaces a traditional notary seeing you sign with ink and putting their stamp on the document. But that's not the case in every state. And there are some states that also require, if you're applying for a mortgage loan, that the mortgage lender has to work in an office. If that's the case, then, and we're suddenly in a situation where everyone's working remotely, those lenders aren't going to be able to write loans unless their state allows it. So, the process, you might be able to go to the open house, you might be able to put in an offer, but then come closing, things could get tricky if the situation gets much worse. So
Yeah.
I think that's kind of where we're at right now.
Yeah, well, I guess
not a concise answer, but
no, it was good. I mean, I think like everything else, we just don't know. We're going to have to see how things kind of play out, and that's why we're talking about it. Jacob, always a pleasure chatting with you. Appreciate your insight. Stay safe, and we'll chat with you again next week.
Yeah, talk next week. Stay safe. Take care.
Welcome back, and now it's time for our personal finance segment. Joining me on the line is Ms. Mari Backman. She is the personal finance reporter for The Motley Fool. Hi, Mari. How are you?
Doing okay, Jeff. How are you?
I'm doing okay, all things considered. Lots of market tumult, lots of things going on. But, the day goes on and the podcast goes on. And I know there are some things other than coronavirus you want to talk about. So what's going on in your world?
Yeah. A little tired of the C word. I kind of figure let's talk about taxes because, like it or not, tax returns are still due. I mean, we're still going to have to, take care of our taxes eventually. So might as well help educate the public a little bit on two terms that tend to get confused with one another. So I thought maybe we could just clear them up so that those people who are maybe doing their own taxes could understand what they're dealing with.
Sure.
And Jeff, those two terms are tax credits and tax deductions. People tend to use the terms interchangeably, thinking they're the same thing, but they're really not. And understanding that distinction could actually just help you understand a little bit, what the value is in each. So let's dive into that. A tax credit, let's start with that.
Yep.
A tax credit is a dollar for dollar reduction of your tax liability. And here's what that means. If you have, let's say you calculate, your taxes and you figure out that, you owe the IRS $2,000. And then all of a sudden you realize, hey, I'm eligible for this tax credit that's worth $2,000. Suddenly your tax liability is reduced to zero.
Oh, wow.
Because because for every dollar that credit is worth, it takes $1 away from what you owe the IRS in taxes. So tax credits are really valuable because again, they're giving you that direct kind of, reduction in what you owe. The only thing is that not all tax credits are refundable. So that if you owe the IRS no money, most of the credits that you can claim, you won't necessarily get paid back. The most credits can do is reduce your tax liability to zero. But there are some credits that are refundable. So that if you owe the IRS nothing, and then let's say you're eligible for, a $2,000 tax credit, you would actually get that $2,000 back. So you'll often hear that, low earners say, well, my income threshold is this, I don't have to file a tax return. That's not necessarily a great idea. Because there's one tax credit, Jeff. It's called the Earned Income Tax Credit.
Yep.
It's really a very valuable credit. It's designed for low-income households. For the 2019 tax year, it could actually be worth well over $6,000, depending on how many children you have. And that credit is refundable, so that even if you don't owe any tax, that the IRS could pay you that money.
Wow.
So. Yeah, so it's really important to kind of take a look at the different tax credits that are out there and see what you qualify for, because that really could end up being a lot of savings.
Yeah, it sounds like
so,
Well, Mari, let me ask you this question. I was as you were talking, I don't mean to interrupt your flow.
No, that's okay.
Because I love being. I think I and the audience love being educated by you. I wonder what the amount of earned or these tax credits that people actually walk away from, meaning they don't file correctly. It's got to be in the millions, if not tens of millions of dollars that people kind of forfeit. And I think that's why you're
We don't,
bringing this up.
yeah, it's a lot. We don't have to guess at it because the IRS even says that, or data says that basically about 20% of tax filers who are eligible for the earned income tax credit don't actually claim it.
Oh, wow.
Either because they don't bother filing a tax return or they just don't know that they can claim it. And again, that's a lot of money. I mean, the credit, like I said, for the 2019 tax year is worth, can be worth over $6,000. And again, that's money that can be paid to you. So yeah, you don't want to pass that up. And, there's other valuable credits too. I mean, a lot of the credits out there, once your income exceeds a certain threshold, you're no longer eligible or the credits start to phase out. But for example, there's this other credit called the child tax credit. Basically, you could get up to $2,000 back per child in your house.
Right.
The income limits for that are really high. The credit doesn't even begin to phase out until you get to $200,000 of income if you're filing as someone who's single or head of household or married filing separately.
Yep.
And then if you're a joint filer, you get to earn up to $400,000 before that credit begins to get chiseled away. So, that's another one to just, for parents should keep on their radar. The good thing, Jeff, is that I think a lot of people today are filing electronically, and when you do that, even if you're doing it on your own without the help of an accountant, you're going to have, prompts in that software saying, okay, this is a good credit for you, or you're eligible here, there. It's the people who do those paper returns, those old school paper returns, who I think really risk missing out on some of these opportunities because there's no, little ding popping up on your screen saying, oh, don't forget this, So those are the people who I think we're really kind of gearing this toward also. When we say don't miss those credits, it's those paper filers who have to be careful.
Yeah, and hopefully they're all listening to the podcast or watching our television program and are keeping those people who file with paper so that they don't lose track of this. So I cut you off in the middle. I think you were going to go into what a tax deduction was. So I do apologize.
No,
please
that's
continue.
all good.
I'm taking notes.
I'm going to before I talk about tax deductions, I'm just going to say that, just by the nature of, this broadcast, it may be that, we're not necessarily reaching those people who are maybe not so technologically inclined. But if you're listening, I would say if you're listening to this, and maybe you have a parent or, or just, someone who's not so tech savvy, just let them know that that filing taxes electronically is actually really easy. They make it really easy to do.
Yeah.
Just something to keep in mind. Okay, tax deduction. So tax credit is a dollar for dollar reduction of your tax liability. A tax deduction is a little bit different. A tax deduction basically exempts a portion of your income from being taxed, so that if you claim a $2,000 tax deduction, that means you don't pay taxes on $2,000 of what you earned. That doesn't mean you save $2,000 in taxes, though, and that's the big distinction. So a tax credit, no matter what tax bracket you fall into, a tax credit is worth the same. So if you're in the 24% tax bracket, if you're in a higher tax bracket, it doesn't matter. A $2,000 tax credit means you save $2,000 on your taxes. With a tax deduction, your savings are really a function of your tax rate. So that, just to throw out an even number, if you get a $2,000 credit and you're in the 24% tax bracket, you're basically saving yourself $480 in taxes. But you're not saving the full value of your deduction. Deductions are still valuable, but don't mistake it for, the fact that you're saving that full amount, because you're not.
Yeah, that's good to know, and that helps lower that adjusted gross income, right? And that ultimately is what goes in that calculation, the algorithm to figure out what your with your tax rate and everything, to figure out what you actually owe at the end of the year. Let me ask you a quick. We've got about 30 seconds, about a minute left, Mari. I want to ask you that I've heard some rumblings. I want to get your sense for this because you're more boots on the ground than I am. Have you heard anything, given what's going on with coronavirus and staffing, that maybe there's going to be a delay?
Yeah, there's been talk of it. I don't think they've announced anything officially, at least as of when I last checked, which was probably yesterday. I haven't really done much digging today. I have a feeling they're going to have to do something, just given the crisis we're all in.
Yeah.
The other thing that people can keep in mind is that you request a tax extension. There doesn't need to be a global health crisis. You don't really need a specific excuse. You can always bump your personal deadline back or push it back 6 months.
Right.
You just have to file for that extension by April 15th. Normally, a tax extension, though, it only gives you more time to submit your return. It doesn't give you more time to pay your tax bill, so that if you owe money to the IRS, anything that you don't pay by April 15th, you start to incur, penalties and interest on that. But I have a feeling that's what they're going to end up being a little bit more flexible with. There, like you said, there's rumblings, so let's wait and see if that April 15th
and I think
deadline gets moved.
Right, and I'm thinking also about staffing at the Internal Revenue Service. They're already short-staffed as it is. Now you've got people working from home. You've got, if they live and work in the D.C. area, and I don't know where all the taxes go, all the returns go. My sense is they go all over the country, but depending on where they are in the metropolitan area, they may not be able to get into the office because of what's going on. I would think that would also be cause for delay. And the last question, Mari, I have is I've heard some rumblings about, I know the president, the Congress, they've been meeting about some possible exemptions in, I want to say, Social Security taxes or something, or delaying those, exempting those. Have you heard anything about that in terms of a tax package?
Well, there's talk about, like messing with the payroll tax or easing up on the payroll tax. I think we're still waiting on, decisions here. But certainly, having less tax taken out of your paycheck might, help people who are kind of struggling through this crisis situation. Unfortunately, Jeff, I think in the coming weeks, a lot of employers will hopefully be very flexible about letting people do their jobs remotely, maybe giving them paid time off when they normally wouldn't be entitled to it, if they're stuck home, let's say because their kids' schools are closed. I think it's just going to be on a case-by-case basis. But ultimately, you're going to have those people who are hourly wage earners, and basically they're not going to be able to come to work, and they're not going to get paid. And it's a big issue already. So hopefully there'll be as much relief as possible, and hopefully that'll be something that the powers that be also take into consideration and try to figure out how can we get relief to those people who are going to inevitably be forced to not work for the foreseeable future.
Yeah, and I immediately, when I heard the suspension of these football and basketball and hockey, I immediately thought of the concessionaires, the people that do the parking, exactly who you're describing, because if they're not working, they may not be able to get paid. And there may be people like plumbers and carpenters who have a specific skill that requires them to be in someone's home or on a construction site. They may not get paid either. So this is a big issue.
You can't be a remote parking attendant.
No, not yet. Not yet. Not unless Tesla and others have something to say, or Amazon or Google or whoever it is has something to say about it. Well, Mari, take care of yourself. Great talking with you. Thanks for the non-coronavirus conversation, even though I took us there. But take care of yourself, take care of your family, and we will talk to you again very soon.
You too, Jeff. Stay safe and healthy. That's, I think, the best thing we can all wish each other right now.
Absolutely. Take care. Bye-bye.
Bye.
Welcome back. And now we're going to shift our focus to long-term investing and retirement. And who better to do that with than Ms. Alessandra Melito. She is the retirement reporter with Dow Jones Market Watch. Ali, thanks so much for joining us online this morning.
Yeah, of course.
So always great to talk with you, and I know lots happening with respect to the virus, lots happening in the market. Why don't you give us your perspective from the long-term investing retirement perspective?
Yeah, so this week has been crazy on all fronts, and watching the benchmarks, drop was wild.
Yep.
But I spoke with a few people about, what they should be doing. Obviously, for most people, financial advisors say don't do anything when it comes to your 401k or your IRA. If you're not retiring for a few more decades, there's absolutely no reason for you to be doing anything except maybe like buying more shares, putting a little extra money into your portfolio to buy the dip, or what we think is the dip right now. Who knows? So that's one thing. But also risk tolerance. So I love talking about risk tolerance because I will talk to people who are like, yeah, no, I don't get scared by market volatility. That's totally normal. And then something like this week happens, and all of a sudden everybody's, stressing out. And they're like, oh my God, it's a bear market, and what's going to happen? I'm going to lose all my money. So I spoke with some experts about risk tolerance, and how that's really what you should be taking on right now. Maybe don't look at your 401k, but do look into your own personal feelings towards risk. If you were afraid at any point this week, that does not mean that your risk tolerance is less than you thought it was. It just means that you are a human and you have emotions, and investments are emotional, and therefore you reacted. So a lot of people have told me, now is not the time to be doing anything, even if you have realized that your risk tolerance is way off base and not at all aligned with your portfolio. You should still hold off a little bit longer, talk to a financial advisor about plans to take after the fact, but don't act yet, because if you do sell investments, you can, you're realizing those losses, and that's not good for you or your portfolio or your future retirement. So yeah, that was one major aspect of this whole market volatility that I covered. Some people said that obviously, if you do realize that your risk tolerance is, if you're not capable of handling the risk from this particular week, that maybe you should adjust your portfolio accordingly. But when you do that, it's important to note that you're also you're going to lose some potential returns in the future. So risk and investment, aside from the fact that who knows what's going to happen with the market in the next couple of weeks or months, but you do. Oh, I lost my train of thought. Sorry. You do. It's a balance. All of this is a balance. Yeah. So like when you're investing and you're thinking about your risk and you're thinking about your future, you have to balance everything. And that means taking into account how old you are and when you plan to retire and how much money you think you'll need in retirement and how much money you currently have. So that's obviously some of the major factors for creating the portfolio that you create. And if you change your investments to be more conservative to protect yourself or your fears around stock market volatility, then you're taking away some of those returns, and you have to make those hard decisions. Like, do you want to, if you really can't sleep at night, then yeah, you might have to do something. But if you can't sleep at night and maybe you're just having a couple of nightmares this week, you should try to hold off of making any rash decisions, because you will potentially not ruin, but reduce how much you have in the future. And nobody really wants to do that if they don't have to.
Well, I love the fact, Allie, that you brought up risk tolerance. I also love the fact that you kind of said it's okay to be emotional and to be nerve-wracked, and that the two don't necessarily correlate together. But let me ask you this. I mean, we've had a bull market for about 10 years. Are we just spoiled? And is that clouding our – I mean, when you're talking to these financial advisors, these wealth managers, people that are working directly with people – I mean, I got to tell you, I mean, I expect the market to go up, but it has just been outrageously overheated in terms of going up to over 29,000. And it's amazing. And I think we in some ways are spoiled. We have not had a recession or a downturn since 2008, 2009, so or maybe 2010.
Yeah, a lot of advisors were saying, I think we all just forgot what market volatility looked like. I mean, like, not that we haven't had some ups and downs in the last 10 years, 11 years, but it hasn't been the way that it has been this week. Like this week, I remember, I think it was Monday, I was in the office, and it was 9 o'clock. We were all chatting in the office, and at 9:30, we all just stared at the television and watched all the red tickers and numbers going down and down, and then them halting trading. And that was just on Monday. And then yesterday, everything's kind of a blur to me at the moment. This whole week has been a blur to me. But I think it was yesterday when it dropped into bear territory. Maybe that was the day before. It's been crazy, and we haven't really seen that in a while. So advisors say, like, we all seem to have just forgotten what it felt like at the time. So, a lot of people have in the last decade been boasting about their account balances and how their returns are so great. And, that's wonderful, but that was not the norm. Usually there is volatility. And it's just, it was just a matter of time as to when that was going to happen.
Did any of the advisors say these 4 words: turn off the TV? Maybe television.
Yeah.
Well, television's all one. I mean, you gotta kind of disconnect, because I was talking earlier in the show with Oliver Rennick from TD Ameritrade Network, and my thesis is that a lot of this is driven because of how things are reported, and that's not to say that there's anything nefarious there. It's just that it's just the way people tend to sensationalize things. So maybe the thing to do is kind of disconnect, not to look. I mean, I think they should read Market Watch for a lot of different reasons, or the Motley Fool, right? I mean, you guys do great, all do great reporting, but you're not just talking about the market going up and down. You guys are talking about principles and foundational elements that are really important. And I think that's okay, but maybe turn off the TV and don't get sucked in to the reality show that is our lives.
Yeah, absolutely. I mean, as somebody who is in the news media, it's hard to say, like, don't read any news, because there are things that you need to be up to date on. But as far as, the minute-to-minute market actions, that stuff, a regular consumer who's thinking about retirement assets, that's something that they don't need to be watching, because that will make you crazy. Like, if you were doing what I was doing, which was basically just watching the Dow and S&P 500 and like all that, like the movement day to day. Even though I don't cover the movement, I was just fascinated by this week. If you did that, like, you would go nuts with your thinking about your money. You can't do that. So it's important, turn off the television after a while. Get the news that you need to get just to be safe and just to be informed. But then, when they start going into the details about like the disaster and the perfect storm waiting to happen and all that stuff, it's been like, maybe, step back a little bit and try to think of happier times, and not focus too much on the, whatever you're afraid of. Some people do need to think about the shorter term, like those who are planning to retire within the next year or 2 years. Like they do need to talk to their advisors. But if they have a financial plan and investment strategy that they made with a financial advisor, or they're just very well versed in investment strategies and things like that, then they've already incorporated market volatility into their plans, and they've already thought about a potential bear market. This is not like this came as a surprise. Advisors have been talking about a potential bear market for years now, because the bull market has lasted so long. So when they make up these financial plans, especially for near retirees, they're incorporating the potential stress and volatility and downturn that could happen. But of course, they should be not worried, but they should be more alert to what's going on and talk to their advisor on a regular basis. Don't call them every single day. That's not going to, nothing's going to change day to day for your retirement. But just to have an idea, like, okay, do I need to change my portfolio, or do I need to change my plans? Like, if I was planning on retiring in June and the market, like the drop has affected my money, and I would feel more comfortable if I could, let it rebound a little bit, maybe don't retire in June. Maybe delay that. If you don't actually care about what your actual retirement date is, then delaying your retirement is beneficial, because one, you're letting the market rebound and, at least normalize. By delaying your retirement, you're still getting an income, which means that you're still putting more money into your retirement account, which is good if the market is low, because, buying more, but also good because more money is more money. And you're also keeping yourself busy, which is right now crucial. So maybe you don't have any plans in July or August or September. So if you don't care about working and you don't mind your job, and you were just thinking about retiring because that's what you do when, you get to a certain age or whatever, hold off on it. A lot of advisors said that's wonderful. Or if you are in retirement, take up a part-time job or consulting or some gig work, something to stash more money away into your portfolios, which never hurts.
Yeah. Well, I think the point is, don't stand still, and you don't have to accept what is being projected. Take action. Allie, always a pleasure talking with you. When after I'm done talking with you, whether it's on the podcast or the television network, I always feel reassured, and I'm a lot happier. So I appreciate that. I'm sure our audience feels the same way. So have a great weekend. Stay safe, and we will talk to you again next week.
Yes, talk to you soon.
Welcome back. Now it's time to close out our show.
Welcome back. Sorry, I couldn't resist. I'm in a good mood.
Welcome back. Okay,
Hey,
here we go.
Are you going to Hawaii, by the way?
I haven't decided yet.
I'm leaving town at this point. I'm going to work remotely and fuck this.
I'm living in a bunker. My house has lots of space. We're stocked up for the millennia, so we're cool.
Okay, here we go. 3, 2, 1. Welcome back, and now we're going to shift gears and pay a visit to the underground bunkers of the Legal Eagles. And joining me on the line are David Levine, Kevin Walsh, both principals with the Groom Law Group, an employee benefits law firm based in Washington, D.C. Gentlemen, thanks so much for joining us on this Friday afternoon.
Thanks for having us on. It's an exciting Friday here in D.C. I sometimes feel like we're at the prequel to a kind of apocalyptic zombie movie where everyone's thinking, oh my gosh, this is going to be great. We're going to work from home for a couple days, only to find out 28 days later that that it's not all it's chalked up to be.
So is that going to be our...
Kevin.
Go ahead, David.
Kevin, in a public sorry, Jeff, in a public service announcement for the listeners, of course we recognize hoarding is bad, but make sure you are ready and comfortable at home, but don't hoard because you need things.
Absolutely.
Well,
so go ahead,
David,
Kevin.
are you saying don't hoard only because I haven't gotten to the grocery store yet, or are you saying don't hoard in general? It sounds like don't hoard is something
Kevin,
someone would say who's not yet prepared.
Kevin, I saw your Twitter feed where it showed you standing in front of your house, armed to the teeth, to protect your Twinkies. Enough is enough here, okay?
Twinkies have a good shelf life.
That's true. They'll survive the next disaster and the next billion more.
And that'll go along with the 80 toilet packages of toilet roll paper that you guys got. So I want to just bring it back, David. There's a lot going on, obviously, in all seriousness, in the country with coronavirus and the financial markets. But I want to bring it back to you and the Eagles about what's going on. What do you see as the most important topics for this week?
Sure. And we're making jokes, and it's not that we don't consider everything that's going on to be serious, but sometimes in moments of stress, people make jokes.
Yeah, absolutely.
I think there's a couple key things I think on the radar for us. I'm going to talk very briefly about a couple things. First, what relief are we getting from our regulators as it relates to the coronavirus? As we're recording this right now, we are looking at the potential national emergency declaration by the president later this afternoon, and probably will have one. Number one. Number two, let's talk about some practical things people need to think about for their plans. Let's face it, taking care of yourself and your family, first priority. But number two, there are some things to think about. And number three, Kevin's going to talk very briefly about legislation. And I'm going to try to be brief on mine as well, because we know our segment is not an hour. It is only a few minutes. So diving in, first thing, the first relief we've received is, of course, on high deductible health plans and health savings accounts, and your ability to be testing for the coronavirus and not have to start using your HSA as preventive care. And the IRS, as expected, came out and said, yes, that's okay. That's a wonderful thing. We would expect more relief. Let's pivot to number two. What's going on out there right there? And shameless plug for our firm, we're going to be doing webinars on this. But at the same time, one thing that's really important is if you're running a plan, now we talk about health and there's all the sick leave issues Kevin will get to. On the 401k, there's what are you doing to monitor? How are you running your governance right now? Because you may not have people on site for meetings. Do you need signatures? Do you need quorums? Do you act by majority vote? Think about all those things. I know that's something I'm talking to clients about right now, and I know Kevin is too. Another thing to keep in mind also at this point is your service providers. What's their backup solutions? Everybody's been worried about redundancy, so that something happens in, let's just pick a state, Iowa or New Hampshire or Maine or any other primary state. And then you always said, well, we got a offsite backup in Arizona, Texas, Oregon. But this is national. So what is this going to mean for service, especially in a time of stock market volatility? How do you monitor your plans? think about what you're doing there. And lastly, if you have defined benefit plans, and I could go a lot weedier, but I'm going to keep it short. Think about, okay, what's this doing for our funding? What's this for our governance? Are there ways we might want to fund up our plans? How does interest rates play in? There's a whole bunch of other things for us all to think about right at this time. So those are my quick takeaways. And Kevin, you want to talk about legislation that's pending as of this hour in our dear Congress?
I'd be happy to talk just briefly about it. And one of the huge advantages that I have right now is that the legislation is not final, but that there is a sense of urgency. So there's been a sense over the past couple of days as the markets have gotten fairly unsettled with initially kind of markets liking down in the equities and particularly on the travel industry to more recently where the Treasury market has acted in an unusual manner, that it might be time for Congress to step in and provide some form of assurance of stabilization, particularly for part-time workers and those in the hospitality industry. And towards that end, they're currently working on a second coronavirus preparedness and response supplemental appropriations act. And this builds on top of I believe it was $8.5 billion allocated to coronavirus efforts earlier this week. Now, these efforts focus primarily in two areas. One is on sick leave, and the second is on seeking to have coronavirus testing covered without a copay. There's a fair amount of disagreement over how the medical leave provisions are going to work. In the initial draft that we saw yesterday by House Democrats, it provided for kind of immediate paid medical leave for most employees. And then it became kind of a standard thing where it was kind of a benefit that had to be provided going forward. In the current draft, it provides for paid medical leave during this coronavirus emergency. The new draft version then also provides for some tax credits for employers as a way of offsetting some of the expenses of offering paid sick leave during this coronavirus emergency. It's likely there's negotiations still ongoing about how that provision is going to work exactly. Other areas where we're seeing kind of some disagreement here is whether there should be breaks in the payroll tax. We know the administration and Treasury have been talking with the House representatives about including payroll tax breaks as a way of stabilizing the economy in this bill. There's been a fair amount of kind of pushback on whether that's going to happen. The Small Business Administration, there's efforts right now to include them in this bill so that they can get loans to small businesses that might be affected by any economic downturn as a result of folks kind of staying in or being sick as a result of coronavirus. And then the last issue that's really kind of hanging over people's heads here is the Hyde Amendment. And this was an issue all day yesterday, which was kind of surprising. It seems as though there's some fear on the part of Republicans that parts of the coronavirus appropriations with respect to health could be used for abortions. So they're negotiating in the hope of having Hyde Amendment language included in this bill. I think we're going to have to wait and see. There's a very clear sense of urgency around the Hill today that they want to get something done. The Senate was supposed to be on recess next week, and it's already been announced they're going to be in session. My best guess is that we'll have an agreement in place by the time this podcast is released, but it won't be enacted yet. That it'll be sometime in the middle of next week before this becomes law.
Yeah, well, guys, there's certainly a lot going on. It's good to see practical responses from the regulatory bodies, and it looks like we're going to get something from the legislature. That's all good. I guess more to come. This is a very fluid situation. Really thankful you guys could come on the program. I know you're incredibly busy tending to your own families and dealing with business from your remote locations, but look forward to talking with you further, I guess, next week as we get more updates, and maybe we'll even have one of you or both of you on the network in the next couple of weeks as well to kind of give us an update. So until then, take care, stay safe, and we'll talk to you soon.
Thanks for having us on. Stay safe, Jeff.
Bye, guys.
Thanks, Jeff. Bye. Bye-bye.
Well, that wwraps up this episode of the BRN Sunday podcast. Hope you found it educational as well as entertaining. And don't forget, we're back again tomorrow morning for the BRN AM we've got another great show. We're going to be talking about taxation and what you need to do to prepare for taxes. So until then, and until next week, I'm Jeff Snyder. Keep on saving and don't forget, roll with the changes. From a young G's perspective, and before me, they got a trick. I have to find a contraceptive. You never know, she could be.